Welcome to the R.E.I. Diamonds Show with Dan Breslin, your source for real estate investment jewels of wisdom.
Welcome to the R.E.I. Diamond Show. I'm your host, Dan Breslin, and this is episode 180 on how buying mortgage notes generates 15% returns and more with Brian Lauchner. If you're into building wealth through real estate investing, you are in the right place. My goal is to identify high-caliber real estate investors and other industry service providers, invite them on the show, and then draw out the jewels of wisdom, those tactics, mindsets, and methods used to create millions of dollars and more in the business of real estate. Today's episode with Brian is a long-form gold episode. The long-form gold episodes run more than 60 minutes because the content provided simply couldn't fit into a standard 45-minute episode. These are my own favorite episodes to record as we're not so limited by the clock. You can review all long-form gold episodes by going to reidiamonds.com/podcast and clicking on the long-form gold link under the categories tab. You might also find other episodes about your favorite topics under those categories. So today's guest, Brian, is a full-time note investor. And although I mentioned 15% returns in the episode title, the reality is that you can run a note business and generate a full-time six-figure income while at the same time building a portfolio of long-term cash flow. And Brian's story includes a transition from wholesaler and flipper to strictly operating 100% in the note business. And one characteristic worth noting would be the flexibility of location that he now enjoys after that transition. So creative financing is a hot topic with real estate investors, but what does that actually mean? Essentially, creative financing is structuring deals with sellers where there are payments over time instead of a simple all-cash transaction like most of us are used to doing. So Brian and I discuss this in detail today, as well as how creative financing can allow you to make deals at higher prices while still cashing out up front. And the best part is that these deals often pay out more than the average wholesale deal and come with additional payments on the back end, so it gets even better. The key to creative financing is case studies. You review a large number of actual deals that were closed with sellers. By reviewing the details of creative finance deals, you get an idea of the different levers that you can pull during a creative finance deal. And Brian and I used the time on this long-form gold episode to display several of these example deals, but we fell a bit short. Now, Brian's mentor is Eddie Speed. Eddie is one of the highest volume real estate note traders I know of. He's closed something like 50,000 deals over his decades-long career. And Brian actually hosts a full-day masterclass at the Note School on originating and trading notes. And this full class at the Note School was designed by none other than Eddie Speed. And later in the episode, I'll share exactly how you can attend this class absolutely free just because you're an R.E.I. Diamond Show listener. And since the class is a full day, you'll have plenty of time to review plenty of case studies and supercharge your creative financing ability. Talk about jewels of wisdom, right? Ready to get started? All right, welcome to the R.E.I. Diamond Show, Mr. Brian Lauchner. How you doing today?
I'm doing good. How about yourself?
Also good. So we're in the dead of winter, early 2021 as we record here. A lot of timely information we've had on the show over the past, few months, even the past year now with COVID kind of upending the world. But just to kind of frame it up, where's home for you? Where are you recording from today, Brian?
I am from the Dallas, Texas area.
Nice. I hear that's a good market recently, but we'll digress for a moment. So I'm recording in Chicago. Our weather is like Chicago weather always is, nice and cold out here, and I'm just loving life.
Yeah. Yeah, Dallas has about a handful of days a year that are nice. and then it's either really hot or Texas cold, which I can't talk to somebody in Chicago about cold, but to a Texas boy, 40 degrees is cold.
Yeah, 40 degrees, we're like almost getting, you could smell barbecues out on the balcony. People are like almost celebrating.
That's awesome.
So cool. Brian, what's your backstory? Before real estate, how did you become successful, and how did you come to end up teaching for the Note School?
Yeah, so I was actually working for a financial software company, and I went into work one day, and I really liked my job. It was beneficial for me, I'll say that. And I walked in one day, and they're like, "Yeah, we don't really need you anymore. We're going to let you go." And so I kind of found myself in that spot of losing my job and kind of just coming home to my wife and my son. My wife was also pregnant at the time. I had a mortgage and bills, and I was the only income earner in my family. My wife stayed home, and so I kind of had to have this conversation about like really what's next, right? I lost my job, what now? And honestly, I think a little bit more open-minded than maybe some, because I had this realization of like I just didn't have control over my finances like I thought I did, because at any point in time they could always let you go. And so for me, I think that kind of opened the door to, well, what does entrepreneurship look like? What does working for yourself look like? And I kind of saw the pros and the cons of that, and ultimately decided, maybe I'll look into real estate. The old saying of there's money to be made in real estate. People always make their money in real estate, but that's such a vague statement. And so I started looking into it, and I got introduced to a friend who's like, "Oh, you should probably look into wholesaling. I think that's kind of right up your alley." And went and got some education, and sure enough, in 2014 became a full-time wholesaler, and just kind of started buying houses, not really knowing what to expect. How many houses do I really need to do? I'm trying to just make a living and grow my company. I wasn't really at the spot yet where I was thinking about I could grow my wealth and all this. I was thinking, my kids are going to want to eat tomorrow, so let's make sure we have some deals in the pipeline. And really started wholesaling houses, and it went pretty good my first year. And I think like a lot of, people who start out in real estate, they start one way and then they start to see the shiny objects, right? So I was wholesaling houses to people who were fix and flipping, and they're talking about how much money they made. And I'm thinking, well, maybe I want to flip houses, right? So I started buying houses to flip or keeping them. And that's just personally not my skill set. I tried to flip about 10 houses at a time, try to have 10 in the pipeline, and it was not my thing. Like, I'm just not cut out for that. And so I just kind of started trying everything else. Got into land banking, owned rental properties, was a lender for a little bit. I actually even owned a property management company for about 6 months before I realized also not for me. And I had a good friend who I literally said, "You can have it all. Like, I just want to be done." And about 2016, so I'd only been in business about a year and a half, kind of had all these other strategies, kind of trying here and there. And I was at a R.E.I, like a real estate kind of meetup, and there was this speaker, and he was talking about building your wealth, and you can make all this money, and using mortgage notes. And I'm thinking, I'm so confused. It just seems like this guy's talking about like, this is something if you're ready to retire, and it's for rich people. And to be honest, I didn't pay too much attention, right? But it was one of those type of meetup groups to where it's very social. There was food, there was a bar, there's your friends, and people that you've built relationships with. And so I don't know that I was truly plugged in, but afterwards I ran into him, and I'm a nice Southern gentleman, and so I'm just like, "Hey, great job on the presentation or whatever. That sounds interesting." And he goes, "Well, what do you do?" I told him I'm a wholesaler. He said, "Well, if you're wholesaling, you should really consider adding creative financing to your acquisitions model. It will change your business." And again, at that point, I'm kind of like, I don't know, man. It's 2016, Dallas, Texas. The market's super hot right now. I don't really need to change, and kind of just, I didn't think anything of it. Well, it turns out that guy was Eddie Speed, the owner of Note School. He's been in business over 40 years. He's done over 50,000 deals now. I didn't really take that in, right? But 2 years later, the market started to shift here in Dallas, And that's kind of what reintroduced me to Eddie. And I said, maybe that guy was right. Maybe he's onto something. And so I went back kind of hat in hand and said, look, I want to better understand. What do you mean by that? Where's the opportunity? And as he started explaining it and I listened, I was like, wait a minute, this is huge. How did I not know this already? And that was kind of the beginning of my journey with Note School. And then in 2020, he said, hey, listen, would you like to join our teaching team and kind of start to teach some classes, teach other people kind of what your journey was like, how they can get involved, whether they are brand new doing their first deal or whether they are what we call the ninjas, right? They're doing 100 houses a year, but they have not quite figured out this creative financing piece. So I said, hey, man, I'd love to. I mean, however I can help, I'd love to provide value the best I can. And that's kind of how I got to where I am today.
Nice. So we're going to get into Eddie Speed and Note School, and obviously people are going to be expecting us to talk about mortgage notes and creative financing if they read the description or listening to the podcast right now. Before we do that, though, Brian, I want to go back to your job at the software thing. And you got laid off, and you came home that day, and then you had to tell your wife that you lost your job. What was that conversation like?
I think I got very lucky in that I was way more upset about it than she was. I was like kind of panicking and like, what do I do? There's this weight of the world, this pressure on my shoulders of, I got to figure this out. And like, probably like a lot of your listeners, like when you're in that situation, you're just thinking, I got to figure this out. I'm going to make this happen. Whatever I got to do, I'm going to make it happen. And meanwhile, my wife did, a very gracious thing. She was very much like, you know what, you're going to be fine. We're going to be fine. We're going to figure this out, based on our faith as well. That was kind of a piece of it that was like, look, things like this, they work out. And I was like, okay, well, good. You don't have to go figure it out. So I guess I'll go panic, in my office. So it was more traumatic for me than it was for her, I think. But, she had enough on her plate. She, had a toddler, was pregnant, and was keeping up with everything else running the house. So.
And then we go forward. How long was it, you find real estate, and we're going to make some money here, and we're doing some research, and there's probably like a gestation period, I'm guessing, there for you. I don't know, 2 months, 3 months, 6 months, a certain amount of time from you lost a job, you figured you were going to do real estate, made a decision, and then it's your first deal. And if we could kind of fast forward and talk about how long that period of time was as you were like learning how to do the business, and then how did you feel? Do you remember what it was like to actually close that first deal? I mean, what did your wife say when you came home after the closing?
Yeah, so I lost my job, and it was about 4 months before I kind of got the training, I would say, to know what I'm doing. And then I actually closed my first wholesale deal 33 days after kind of finishing up some of those classes. And I will tell you that I remember leaving the house to go to that appointment. It was 33 days when I locked up the contract. I remember leaving the house, standing at the front door to this day, and I turned back and looked at my wife and I go, I'm going to go live my dream. And she's like, go get it. I'll never forget saying those words. And I walked out the door and I go talk to the seller. And, I didn't realize this was going to be a very uncommon thing. But I go out, I do my whole presentation. I talk to the seller. I negotiate on price. It didn't work out. And so we started finding out, well, what is a better solution? And I finally got to a price and I got a yes while I was in the house, right? One call, one appointment, I got it done. And I was shocked, like it worked. You know what I mean? And then once I had it, then I had to sell it. And so I came home and I was like, you're not going to believe it. I got a contract. I'm ready to go. This is so great. And, from there, I only had a few buyers. And so I called and I gave them the sob story, to be honest. I just said, hey, listen, this is my first deal. I need you to buy it. I need you to buy it. Please tell me that you can do this. And if I'm looking back at it, I think I made like $3,000 on that first deal, but I would have taken a penny. Like I would have. It would not have mattered to me because I just needed to get one done. You know what I mean? There's so much power in just getting that first deal done. And then once I got that check in my hand, it was like, oh my gosh, it works. It works. Like, now I want to go do this as many times as I possibly can. And so I was very motivated. I was very excited. And it was just, all right, let's get back to work.
Nice. That was transformational. And I remember mine too, Brian. So I had gotten in a car accident. It was a DUI, so I was drinking. It was not my car, so there was some trouble for that. And anyway, so I had no license is where I'm going with that. And I remember I was, settling down, getting out of all that like sticky legal trouble that I had got myself in. I was getting myself clean, sober. I've been sober now like 8 years or something. This is 15 years ago, and still some more trouble back when I did my first deal. But it was like January, February, and I couldn't get a job because I was a car salesman. You can't sell cars without a license, like who in their right mind is going to hire that guy? So I end up, going to the school, figuring out how to not figuring out how to wholesale. It was kind of a, real estate investing, give you like this broad scope of flipping and holding rentals and all this other stuff. And wholesaling happened to be like a small piece of what they talked about. 6 months later in July, I remember that it was the same kind of thing. I go on this appointment. My dad drove me there. I had my 5 or 6 year old daughter with me at the time in the worst neighborhood, drug-wise, crime-wise, shooting-wise that you can possibly think of. And I signed a contract for $5,500, and I'm like, oh crap, I don't know how to fill the contract out. I'm like sitting in front of the seller trying to figure out where's the names go, and okay, here goes earnest money. It was like I didn't even think to practice that before I got to the living room.
Yeah.
And then same as you, I called the 3 or 4 people I knew from the meetups. There was no meetup back then. You just like got on these lists and you had to figure out where they were. So I called the 2 or 3 guys. Hey, I got this deal. I got it for $5,500. I saw you bought the one for $6,000 on Remington Street. I'll give you this one for $6,000. And I'm thinking I'm going to make $500, right? And guys like, oh no. Like, the reason they named it in Remington Street is because of all the Remington shell cases from the murders up and down the block. I'll sell you mine for $5,500. And I'm like, oh, God. My only mistake was not signing the contract with him for $5,500 because I put an ad on Craigslist, sold mine for $11,500, $6,000 on the first deal. And then, a year later, that same guy sold his for $11,000 to my buyer. So that would have been 2 deals in one, but I didn't have the sense to sign it up, looking back. What a journey it's been, huh?
Yeah. It's amazing how you talk to enough investors and everybody's got a story like that to some extent, right? Maybe not their first deal, but it seems to be a common lesson that we learn, right? Whether it's about areas or about buyers or about missed opportunities. It's kind of interesting how we kind of all go through that journey.
Yeah, and it's cool. So before we started the recorder here, we were talking, the transition that you had gone through, and you start out wholesaling, and then I'm just going to fill in the blanks because I know we talked some of it on the episode here, some of it offline, but 20 to 30 deals a year. You have some rentals, you're doing some notes, and you're kind of like more into this creative thing as opposed to having to kind of chase down every wholesale deal that's out there. And I think there's something to be said for that, finding the right amount of deal flow and situating your life so that you have a certain amount of lifestyle and it's not this like endless growth factor. So I'm like, I'm not that. So like my motivation is, I want to create a bigger opportunity for my partners, the people on my team at Diamond Equity Investments. I'm trying to transform like a larger number of neighborhoods through the process. And so it's not about a certain number of deals per year, a certain amount of income per year. It's kind of like this very difficult to ever reach the finish line because there's not really a defined finish line where I'm okay with that. And we did like 283 houses in 2020. It's a lot of work. I'm kind of like busy doing that, but you were able to find and settle into this balance. And I would ask, like, what is your motivation now, right? So you've gotten into this comfortable cadence with the right amount of deals, and you're doing some notes, and you're having this passive type of business that's set up for yourself, and having just the right lifestyle you want. Like, what motivates you to get up out of bed and do what you're doing now at this point in your career, Brian?
Yeah, so in 2016, kind of when, actually, interestingly, the same year that I met Eddie, My daughter, I remember I said that my wife was pregnant. Well, my daughter, when she was born, she happened to be born with this rare autoimmune disease. And we spent years really struggling trying to figure out what was wrong with her. And, we went to countless doctors and hospitals and spent a fortune trying to basically save my daughter's life. And it was during that time that I really said, I've got to create a vision that is going to be sustainable. I don't want to be a firecracker and burn out. I want to do this for a long time. And I want it to be sustainable. And so I kind of just started to write out this vision of what do I want my life to look like. If I had $10 million in the bank and I had, a full week completely open, like I have nothing on my calendar, what would I want my life to look like? And I kind of started to write it out. And I say, what's most important to me right now? It's family, it's kids. I've got a 5-year-old and an 8-year-old now. My daughter's fine, by the way. So we're really grateful for that.
Nice.
But I started to kind of map that out and then say, all right, well, if I want to do that, I have this many hours in a week left to work. If I want to be able to do this with my family and this with my kids and take these trips, what kind of business do I need to design that could fit within, those hours? Let's say it was 30 hours or 40 hours, whatever it is, that you come up with. And then I started assigning a dollar amount. All right, what do I need, to be able to afford this? And based on that number, I kind of just reversed engineered it and said, all right, my average deal is about this. So let's be a little conservative. Let's round up and do this many deals. And so I've just basically done consistently 20 to 30 deals a year to be able to create the lifestyle that I wanted. And, so the motivation really consistently has been about time. I had really incredible parents, Dan. I really did. And my dad was awesome, but my dad, he just bust his butt. He lost his father at 11 years old. He had to get a full-time job at 13. Like, he just had a tougher life than I can relate to. And because of that, hard work it's just who he is. And growing up around that, I respected it. I got a lot of value out of it. But as I became a man, I said, I want to find a way to make the money without having to give up all my time. And so that really started to drive me towards this idea of there's got to be a way, and so just writing out that vision, kind of reverse engineering it, and it really just keeps me focused on how many deals I really need to do a year. And if I get to, let's say 30 deals early in the year, I could say, well, let's just do more deals, or I could say, let's take another trip, So it allows me to kind of have those options, and the strategies that I use provide that flexibility.
Yeah, I think that's pretty cool. So, like, my daughter was 5 or 6 in 2006 when I was getting in the business there, and I was completely broke and dejected. So there was no software skills. There was no getting the job that was. I had nothing to fall back on, and there's people. There's something to be said. You get laid off, or you have no other options, and you have no choice but to make it forward. Kind of like what we did, right? Yeah, you could go choose to get another job and another career, right? But you're having to do something. Your back's against the wall, and I look at some people who have this conscious decision of, I'm going to walk away from this great prosperous career and make it in real estate. And I'm going to be honest, when I hear that, Brian, sometimes I'm like, yeah, I don't know if I would have wanted to do that. I see a lot of people do it successfully, and I love my life and the lifestyle, but I'm kind of glad I didn't have to make the choice to let go of, some valuable thing to then, move on to the new thing. But anyway, I digress. Let's just, on your story there, I just want to put one more piece of context here. So like in 2019 or even 2020, you had made some mention about, the deals you do or are doing are more passive. Would you mind describing, a little bit of or a few of the examples of the recent deals that you've done, as opposed to like the wholesales that kind of got you started?
Yeah. So let me I'll even back up till kind of 2018. That'll make more sense of how we got to 2020. So in 2018, I started focusing more on buying on terms, meaning that instead of going in and offering a lower wholesale price, let's say it's a $100,000 value house and I got to buy it at 70 cents on the dollar to be able to wholesale it to somebody, I got to get that seller to take a discount. Instead, I started shifting things to say, look, I don't care about what price you want. I will give you whatever price you want. It's about when I'm going to pay that price. So I'll give you the price, but I'm going to give it to you over time, right? So I'm going to have the seller finance me the property. This solved my banking needs as well as my inventory needs, because now every other wholesaler I was competing against was saying 70 cents, and I'm saying, I'll give you 85. I'll give you $92,000 for it. A lot more money, right? And sell specifically the people I was trying to target were people who they hadn't sold it to a wholesaler for a reason. So it became a little bit easier to be like, well, look, if you won't sell it to them, you need this price. I can give you that price. And what that did is that allowed me to then acquire a property. And then what I did is I turned around and I resold it using seller financing to somebody that actually Eddie Speed has the perfect name for it. He calls it a penalty box buyer, which is pretty much just somebody who they just barely miss the conventional mortgage type box, right? They're not quite bankable yet. Well, they're bankable enough for me, and especially if they've got a reasonable down payment. And so that allowed me to make my money today by getting a down payment. And most of the time you're going to make, or at least in my case, I was making more on the down payment than I was going to make even if I wholesaled it. So
nice. That
was kind of a bonus. I was making more money today, but also out of that same deal, now I get payments from that person for years and years and years, making it passive. And so now that I've resold it and I'm getting these payments are, the seller's the penalty box buyer has promised to pay me those payments. Well, now I have a note. That's what a note is. It's just simply a promise to pay. And once I got introduced to the note business, it became this realization of like, oh my gosh, this is how the banks work. This is it. They loan money out and they expect the payment in return. The difference is I'm loaning the seller's money out. I'm loaning somebody else's money out, and I'm making all the difference. And that was kind of in 2018. And then in 2020, I really transitioned to, I'm just going to go and buy discounted notes. And this is really what Eddie is known for. This is how he's done over 50,000 deals, is he helped kind of take my business to, look, you can buy a note from a note seller. And if the house is worth $100,000 and let's say the mortgage is $60,000, you can buy that note at $50,000. So now you're at a 50% investment to value. So your risk is lower. You're getting cash flow. If they don't pay, you're always protected by the asset. And then there's just even more and more strategies that you can take that one deal and break it down and even sell parts of that note to get capital. You can borrow against that note to get capital. So it kind of slowly started transition into, I found a way to make the income that I'm wanting, just by playing the role of the bank. And also I get the benefit of, I can grow my wealth on the side because I'm stacking up all these payments on the side that are bringing in cash flow.
So did you have to have a certain amount of capital between 2014 and 2019 or so when you transitioned to strictly buying notes? Like, does it become a game of, okay, I've got $300,000 in cash now, let me select the right notes to, get the payments that come in? Or is there still this transactional nature to the way that you personally are running your portfolio, where it's maybe, buy a discounted note at 50, sell it for 55, buy another one at 45, keep it for some reason? I mean, tell me about kind of the mix of how your portfolio is churning currently.
Yeah, so basically what I can do is I can go buy, for example, I bought a note in Ohio here recently, and I bought it for $24,000 and some change, right? And I think there's 23 or 24 years left on that note. It's a pretty long note from what I remember. And what I'm going to do is I'm going to go and I'm going to find other people who want a passive investment. They want to use their money, right? And they want to get a really safer, in their mind, safer, right? Meaning just lower risk return on investment, but they want to be able to also tie it to real estate. And just as kind of an aside here, my target audience is the landlords who have really only owned a rental property in the last 5 to 10 years. And typically they have only 1 to 5 rentals. And the reason that is because within 1 to 5 years, that's the most painful part of owning a rental property, right? Your cash flow hasn't increased because there hasn't been enough time. The property hasn't appreciated enough to refinance and pull all your money out. Anything you forgot to fix when you rented it is now breaking. You're putting more capital into this thing, but you're getting the same cash flow, which means you have the exact same return on investment that is going down and down and down. And I'm going to these people and I say, look, you like the fact that you get cash flow. You like when the tenant pays. You like the fact that it's attached to real estate. So if somebody gets hit by a bus, the money is going to be locked up in that asset. You could always sell and get your money back. But you hate the tenants, the toilets, the turnover, the putting more money into an asset that's supposed to be paying you. So what if I could offer you an opportunity to keep all of the good and I'll take away all the bad? And what that means is you're going to play the role of the bank, right? And these types of people are the same people that would say, yeah, I'm interested in getting the cash flow. I'm interested in getting something, investing my money in something that's going to be protected by real estate, but I never really wanted to sign up for tenants and toilets and putting more money into an asset that's, going to, drive my returns down. Now, just as quickly to say this, I'm not knocking rental properties, right? I'm just saying this is a different way to do it, and everyone has preferences. And what I found is there's a lot of people who have preferences of the only reason they're in rental properties is because that's kind of the option that was presented to them, right? They didn't know they could play the role of the bank. And so I can go to that person, right? If I go buy a note, this $24,000 note, I can go to this person and I could sell them the first 10 years of that note, right? So if I bought a note that has let's say 12% return on investment to me, I could sell 10 years of that note to this investor over here at a 6% return on investment and recoup probably all of my $24,000, if not a little bit more. And that means I get all my money back, maybe a little bit of a fee, a little bit more, plus I also get another 10, 15 years of payments that are going to be paid to me in the future, which is really going to build my wealth. And that's kind of hard to explain just over the phone, right? But I've got a great way of showing it and teaching this, same way Eddie taught me, that I teach my investors and then I could show your audience. But that's kind of how I do it, right? Is I could put up some money if I want to, but then I'm going to recoup that through another investor who just wants, they want to get a solid rate of return. And a lot of these investors too, I'll tell you this has been fascinating to learn, is I start the conversation of, well, what are you making on your rental property? Oh, Brian, I'm making 8%, 9%, 10%. Oh, interesting. Okay. You really think you're getting that? Or that's just that's what the paper says. Well, that's what we mapped out. All right, well, let's take a look at that. How much have you actually put into this? Did you take out any sort of capital expenditure type of budget? Do you pay a property manager? Well, it turns out that 8 to 10% is really their gross number. And last year they actually took a loss because they had to replace the air conditioning unit. And, so we average it out and it's like, look, you're only getting 6 or 7% anyway. What if we could take all that risk away or at least mitigate the risk substantially, and you actually get a payment more consistently than your tenant is paying? So it just, it kind of opens the eyes to, there might be another way to do this and still get what you want. And that's why I always say you can keep all of the good, but I'll find a way to take away all the bad.
Gotcha. So it's less about me saying, all right, Brian, I got $300,000. Let me figure out how to get a little capital, get a little portfolio of notes and then just sit back and never lift another finger. Maybe I could do it that way. And more the way that you're doing it personally, I would say is it has that entrepreneurial, transactional real estate investment feel to it, just like flipping houses or wholesaling or any of these other things. And in both ways that you described, just so that I'm understanding correctly, we either have houses that we're buying on terms and then immediately reselling on terms, which brings us this chunk of cash up front, which may or may not be recouping what we had to give that original seller. And the same kind of thing is going if it's strictly a note purchase and then you're selling a part of it, in that I guess the basic big idea here is any cash that's going into the deal is immediately extracted by Brian Lauchner, probably at some point in the first 3 to 6 months, if not 12 months. Does that about hit the nail on the head?
Yeah, except it's way faster than that. So, and you can take it even one step farther. The general rule of thumb is you won't need any of your money to do any of these strategies, right? Like my philosophy in business is I should never have to use any of my money to do any deals. Why is that? Because I'm bringing the knowledge and the deal to the table, and being the knowledgeable one protects the investor's money, right? If I bring in good deals, money is never the problem. And Eddie's helped me a lot with raising capital. But even if I wanted to borrow money, let's say somebody wants hard money rates for whatever reason. Okay, I'm going to borrow your money at 10%, 12%. I'm going to buy a note with it. But that's going to be short-term money, right? Then I could go to another investor if I wanted to. And I've just built up relationships. I'm converting a lot of my hard money lenders. I'm converting a lot of my landlords. I've also got several real estate agents who they like the lower risk factor. And it's just like I've had coffee and lunch with these people over the years, and all I'm doing is calling them up and being like, hey, do you want to hear about how you can get involved in this note, right? And so I go from one hard money lender, so to speak, to a private investor, and we're doing it in 30 to 45 days. As soon as I can get the documents filed with whatever county in the country that I'm buying the note in, because this becomes truly virtual and truly national, right? I don't have to worry about it being in my area. I can just go to where the right deal is or the good deal is. It allows me to turn them over really quickly. I can use somebody else's money and then get a long-term note, you know, or long-term investor to come in and pay that off. And that's just one way that, you know, I'm always thinking, how do I use someone else's money? And that way I'm just recouping all of the money that I borrowed at the hard money rate plus extra for me to make a profit today. And then I'm also going to have cash flow in the future on the backside.
So what about the admin on this stuff? I mean, to me, part of why I cringe, I love a wholesale deal and I love a fix and flip deal. I do own rental properties. For my audience who already knows, but my rental properties, I kind of treat them like as my savings, but like I am not the landlord who is running out to acquire nonstop this humongous portfolio, and for the same reasons you just mentioned. Oh, it needs a new air conditioning unit. Oh, the tenants stopped paying because of COVID, and there's like 4 or 5 of them. Oh, we have to do cash for keys. Now we got a squatter in this one. So it's this endless parade of large expenses, roofs, new kitchen, pipe leak, right? It's never ending, and I know that my return is not. My return is sitting still mostly on paper in the form of unrealized gains because I still own the property. And there's some tax benefits, and I chose properties in certain areas where I believe values are going to go up, but I kind of put the brakes personally on going too crazy with those rentals. For other things like the admin involved, I have to check my management statements to see who's paying, and I kind of have to manage my management company. I have to contact my insurance company and pay that insurance bill and allocate those expenses accordingly, and I have to sit down and pay all the tax bills. It's just there's a lot of active admin sort of management to make sure that my portfolio is staying run correctly. And I guess if you have scale, maybe you can bring a person on. You're still having to kind of, they create a lot of admin work pretty much. So to me, I hear the note thing, and I have a couple notes I'm in the middle of foreclosing on as we speak, so they didn't work well for me. But they are on secure assets, and if I end up taking the assets back, they're going to turn into probably some of my best deals that I've ever done, assuming these people don't pay off those notes and, you know, cash me back out of the deal. But admin-wise, how can I do this, set it up? You said record the docs with the county, but what's the process so that I would ideally have, like, hands-off, literally the ACH is coming into my account automatically, and it's being done 100% correctly 100% of the time, so I'm not having to, like, chase down tax bills, right?
Exactly, yes. So pretty much since 2014, and obviously before then, but really since 2014, there's been this shift with pretty much anybody who owns a note. You're going to put it with a third-party licensed and compliant, you know, SAFE Act, Dodd-Frank compliance note servicer, right? And these note servicers are the one that are going to make sure taxes and insurances are paid, make sure the mortgage is coming in. They're going to collect all the payments. They're also going to be the one that stays in communication with the borrower, and then they're going to ACH it in. And one of the nice things, and just to give you an idea, it's not like a property manager that it's like 10%. It's just a flat fee. Like I pay Allied, I think it's like $18.50 a month per note. I mean, it's a very nominal amount that keeps me compliant. They handle all the statements, and basically on the 10th of every month, all I do is I sit down and I can pull up all my notes and I look at, okay, who paid on the 1st? Did everybody pay on the 1st? No, they didn't. Okay, this person paid on the 3rd. This person paid on the 5th. Whatever. It's the 10th now. Are we paid? Is everybody paid? If they're not, then I shoot an email saying, hey, can you get me a story on why this person hasn't paid? You know, and they'll kind of walk me through it. But I'm really, you know, you talk about managing property management companies, and I know that feeling so well. And this is one of the reasons I struggled in rentals, is just like, this is supposed to be passive. I feel like I'm spending so much time tracking down, you know, looking at this house, and then they're going to do the work, but then they're going to charge me an extra fee for it. And then I got to approve it, and I got to do all these extra little things. And it's like the third party licensed to compliant note servicer really takes that off my plate. I thought so much about how many notes do I really need to have to kind of I'd say outsource this, right? To hire an admin person to do this for me. I mean, and we're just talking about so many notes. I'd have to have several hundred notes to make it worth it. Just because there's really not too much to look at other than did they pay or did they not pay? That's what this really boils down to. And that goes into how we choose our notes, right? I'm looking for, when I'm buying a note, I'm looking at the borrower specifically the most. And we've got some solid criteria that I can run your audience through sometime to kind of say, look, this is what makes a good borrower. And this is, you know, if they're paying, right? The number one, you know, rule of thumb is going to be their skin in the game. If they've been paying, like this Ohio note I mentioned earlier, they've owned the house since 2011. So they're going to own it for 10 years this year. They've been paying it down. What are the chances that they're going to keep paying if they've lived there for 11 years? Pretty good, especially when they've got, you know, 40, 50, 60% equity in that asset. And so that is kind of my starting point. I'm not Wells Fargo who's like, yeah, 20% down helps me mitigate my risk. No, I'm looking for somebody who's like, they're going to pay, right? And that's part of what keeps the admin low. That's part of what keeps the headaches down, and kind of simplifies this process.
So how many notes do you have right now cooking in that same portfolio we were talking about?
Yeah. So again, I try to buy 20 to 30 notes every single year for the past several years. I mean, I'm trying to acquire as much as I can. Things are starting to shift. Like I have not bought a note in, let's say, about 2 months because the market has an opportunity coming up with non-performing loans that's going to be massive, right? We're in the middle of this mortgage crisis right now. You've got tons and tons of non-performing loans that can't be foreclosed on, right? They can't be foreclosed on yet, but eventually these moratoriums are going to be lifted. And we're kind of just sitting on cash waiting for that opportunity because non-performing loans are the lowest barrier to entry into any strategy you could ever come up with, right? Because instead of buying a note that's performing at, say, 60 cents on the dollar, right, and you're owed 70 cents on the dollar, you can buy a non-performing note at, say, 40 cents on the dollar, and you're owed 100% of the value of the asset, right? So it is, I mean, we're just talking about substantially discounted notes. And you're going to use a third-party note servicer to either modify it to foreclose on it, or I guess you could do a deed in lieu foreclosure as well. But worst case scenario, you get this thing back, and hey, you could sell it to a wholesaler. You could list it on the MLS if you wanted to. You could rehab it, I guess, if that's your thing, or rent it out. But even if you're going to own it as a rental property, guess what? You still got into it for such a substantially cheaper price than you would have just buying it on the open market. So fortunes are made in market cycles like this because non-performing notes, the barrier to entry is just so low. And how easy is it going to be to raise money? Think about it. If I'm borrowing money at 60 cents on the dollar, that's pretty low risk. But if I'm going to investors and saying, hey, I need to borrow 25 cents on the dollar for these assets, or I need to borrow 35 cents on the dollar for these assets, their risk is pretty low, right? They're pretty protected. They know they're going to get their money back. That does two things. It gets me more money, and it also lowers my cost of capital because they have lower risk. It means I don't have to pay as much money in interest.
So other than, looking at the time, the seasoning of that note, is there anything else criteria-wise you're looking for in a borrower that is you're potentially going to buy the note?
Yeah. So, I mean, outside of just the seasoning, I'm looking for pay history, right? I'm not buying a note that only has, 6 months of seasoning typically. I've got years of payment history, and I look at that payment history. And for me, I'm pretty, I don't know. I look at it, if they paid for the month, it counts. Like, I don't care if they paid on the 1st, the 5th, the 10th. I don't care if they paid on the 20th. If they paid in that month, it counts. And I just look at it, and I look at, all right, cool. They've paid every single month. Right? Maybe not on the 1st, but they've paid every single month, and that's what I care about. In previous years, like not this current year, like for example, the note I bought in Ohio, I looked at 2018 and 2019, and I made sure there was 12 payments. And what that means is they might not have paid in March. They might have made 2 payments in April. Or I've looked at a lot of pay histories recently that they'll pay 3 months in advance. So again, as long as they're paying, that's what's most important to me. Some people, their preference is I want them to pay on time. And again, that's just one of the things you're going to vet. The other thing is the collateral, right? The house itself. I don't want some blighted asset. I don't want some, this thing looks like it's in a really rough part of town, or it's named, Gatling gun, or it's named Remington, like the area, what am I putting my money into? That's of course something that I take into consideration. But those are the main things. Other than that, it kind of gets more into the preference side of it, and what you're trying to accomplish with that note. Are you going to flip that note? Are you going to wholesale that note to another investor and just make a fee? Are you going to sell part of that note to another investor? What are you trying to do with it? And that exit strategy ultimately is going to help determine what kind of things go into it. Other than that, it really boils down to the last thing is going to be the paperwork side of stuff. If this note was created by some investor on the hood of a truck, is this thing even subject to Dodd-Frank? Is it compliant? If it is, this is not a rocket science business. But some people, they'll write up a note on a napkin and then they'll try to sell it, and I'm not really interested in that. So I know some people deal in that space. I've never really, that's kind of it's got to check a box. It's got to be a legitimate contract. I need to see a purchase and sales agreement. I need to see a deed was filed. I need to see some things like that. But that's pretty much it. I mean, as far as a high level goes, as far as what I'm looking for.
So you mentioned Dodd-Frank twice now, and can you describe what Dodd-Frank is? And you talked about, is this note subject to Dodd-Frank? I assume that you mean, perhaps like originating a certain number of these mortgages and notes myself might land me in a place where I'm supposed to be registered or compliant with Dodd-Frank. Can you just kind of touch on that regulation piece of the business?
Yeah, in fact, let me actually simplify it really, really well, because Dodd-Frank is like thousands of pages. I haven't read it. I don't know really anybody who has read it. Right? Everybody reads basically the Reader Digest version, the bullet points of it. The bottom line is there are certain things that you have to do. If you want to be a note holder, you have to do certain things to stay compliant with Dodd-Frank. Or you can hire a note servicer, and the note servicer has to do it. If you hire a note servicer, you're basically removed from all of those stipulations, because that's the entire job of the note servicer. So kind of tying it back into the admin piece about, well, you got to do this and you got to do this. The answer is, do you have to? Yeah, but you're never going to do it. That's literally what a note servicer does for you. For example, producing a statement every single month. You think I want to sit here and calculate, all right, how much they paid and, prorating the interest? I'm never going to do any of that stuff. This would be a nightmare business if it required all of those steps. I pay somebody $20 to $30 a month. Like I said, Allied's, $18.50. There's a loan servicer here locally that I use when I do creative financing deals here in the Dallas area. That's $30 a month. I mean, it's $20, $30 a month. It takes all that work off my plate. I don't have to worry about compliance. I only look at it from a standpoint of if an investor brings me a note and says, yeah, man, you want to buy this note from me? And it literally looks like it was written on a napkin on the front of a truck, right? That's not appealing to me.
Yeah, that's a pass. So what about, do you know anything about the origination piece? So you're buying and selling notes passively, personally right now, but 2 years ago, you were actually originating these notes. And I'm sure when we touch on the creative financing, that's exactly what's going to be happening. Is Dodd-Frank governing some of that activity also? And is there a way that you found where you're compliant in that place?
Yeah, love it. Great question. Again, general rule of thumb, I'm going to try to remove myself from the risk, and I'm going to try to remove myself from the work. And so part of how I was taught this is you're always using a third party, right? I'm going to use an RMLO, like a mortgage lending officer, who is going to vet my buyer, right? I can't go to my buyer and be like, I want to do credit check, and I want to do this, and I want to do this, and I can't ask for all of these things necessarily, according to Dodd-Frank. On top of that, Dodd-Frank's real objective was to get rid of predatory lending, right? And so the whole, staying compliant with Dodd-Frank is somewhat common sense. For example, if somebody shows you they have $500 to put into a $200,000 house, that's their down payment, $500, and they can afford $1,000 a month, right? If you write them a loan, right? If you originate a note with them, you say, yeah, sure, I'll sell you the house, give me the $500 down and $1,000 a month. But you don't think about the fact that if you take $1,000 a month, they only make $1,800 a month total, right? this is more than 50% of their income. That falls into predatory lending. In other words, you know they're going to fail. You know that you're going to end up taking this house back, foreclosing on there, keeping their $500 or their $20,000, whatever they put into it. It doesn't matter. A lot of this is common sense. Just like you wouldn't rent to a renter who can't really afford your rent, because you're going to have to evict them. I'm not going to sell a house or an originated note to a buyer who's not going to be a consistent payer. I'm looking for less brain damage. I'm looking for less headache. I'm not interested in trying to work some scheme on somebody to be able to take their down payment, tell them to get lost and then find another, buyer. Like I'm not in the foreclosure business, or at least I don't want to be in the foreclosure business. If I am, I'm going to go more the route of, I'm just going to go find somebody, a hedge fund or an inventory source to sell me non-performing loans, and I'll just buy those at a deep discount. And then even then, I'm going to try to work with the homeowners to give them a second chance, because when you kind of approach it from that way, you're back into the reperforming loan side of things, and it just gets a little bit prettier.
So how do you avoid foreclosure process on those non-performing loans that you buy?
So our main objective is to modify the notes, right? If I can buy a note for, say, $20,000, and let's say it's worth $85,000, and let's say the borrower owes $75,000, right? They only have $10,000 in equity. If they owe me $75,000 and I buy the note at $20,000, I could say, you know what? Let's modify this loan to a payment that you can afford. I would much rather see you repaying. Why? Because there's $55,000 in equity sitting in there. That's mine. I just got to get them reperforming. And if they don't want to reperform, if they're like, if I have a note servicer go knock on the door, they'll literally go knock on the door and get the whole story. If that person's like, screw you, man, I'm never going to modify this thing. I'm never going to pay you. Okay, well then I'll exercise my legal right to probably foreclose. And actually, because I'm a nice guy, I'll probably go a step before that and say, look, why don't we do a cash for keys, right? I'll give you $2,000, I'll give you $3,000, just leave the house nice. If they don't want to do that, then I'm gonna go and I'm gonna go ahead and foreclose. But even if I got to foreclose, which, I mean, even when you look at 2008, you look at somebody like Eddie's portfolio, and even in the worst of times, he only had 30% of his non-performing loans he ended up taking back. I mean, the majority of these you're going to be able to work out, right? And that's a really cool part of this industry too, is you can help so many people get a second chance. A lot of these people, and I think COVID's a perfect example, a lot of these people, they're not bad borrowers. They're good people. They had a hiccup. They lost their job. There was this pandemic. They had no control over it. They just need to be reset. They need to be given a second chance. They got their job back. They got their income. They've lived in the house for years and years. They raised their kids there. They have family events there. Like, this is important to them. And you get to step in and say, look, I'll give you a second chance. I can do something that the Bank of Americas of the world aren't really set up to do. And that's give you a little bit more of a personalized approach, which is twofold. One, they get more value out of it, but two, I get to dictate the terms that I want for me. And I can help a lot of people that way, right? And then the 30% of the people who just, look, if you don't have a job, I can't really modify it, right? Like, it's one or the other. In that case, let's try to do a deed in lieu so you can kind of move on to this next chapter of your life without having a foreclosure really follow you around. And then, I'll sell the house or whatever I'm going to do with it, right?
Got it. Can you give me, let's play with one of the examples. You've done some non-performing notes yourself?
Right.
What would be kind of the, yeah, it definitely is. I mean, I remember, I guess 10 years ago was a really big year for seconds mostly, or when it started to become, it was probably a 5 or 6 year period from 2007 to about 2013 or 14. And then the second note inventory really started to dry up, because the eviction moratoriums and things of that nature that were occurring during the last real estate crash, all that stuff started to cycle through the system. So I noticed that, on a secondary market for mortgages, there were no, or certainly a lot less second notes, and they ended up getting bid up pretty high. And it'll be interesting to see how many people are actually buying notes, with it being a much more vibrant market now than it was 10 years ago. Of this demand, perhaps pricing up the deal. Do you have any examples of some really solid, and if it's not a non-performing note, but like where I'm going with it, Brian, I like big returns, and so does my audience, right? I pay 2 points and 10% interest to my private money lenders, so they're kind of like spoiled and used to getting really decent returns. And so I'm going to go out on a limb and say a 15% return would be sort of the threshold that would get some of my audience excited. And I know some of them are going to hold out and say, oh, no, I need 20, 25, 30% on my money. But let's be realistic. Want a 15% return on my money to go ahead out there and look at this note that's in Ohio. So like my audience is not going to be the one buying 10 years worth of notes. They're going to want to be in your shoes, and they're going to be wanting to evaluate that and find that. Do you have any deals that kind of worked out where maybe it was 15% or maybe it was even more? And that's from your perspective, not the partial note buyer's perspective or the investor.
Yeah, it's a great question. I've got, unlimited deals. Do you want to, or examples anyway? Do you want me to tell you on the performing side, or do you want me to tell you on the non-performing side?
I want you to tell me on the one that when I don't care whether it took 4 months, 6 months, and you get it reperforming. If that was your best deal, I want to hear about that. Or if you happen to buy one that was performing, or even set the note up from the beginning, I kind of want to know what's the best one? What's the one you would tell at a cocktail party if you were trying to show off?
Yeah, I'd probably say the non-performing side. And that note I kind of gave an example of a minute ago is actually, it's a non-performing note in Missouri. You got about $21,000 and some change. You're all in at $21,000, right? The note that's owed, like the debt that's owed on the property, was $87,000. And this is what's really cool about kind of this non-performing space is we're owed $87,000. We're all in with the modification and everything. We're all in for $21,000 and some change. The nice part about notes is Eddie Speed says all the time, it's your chalk and it's your chalkboard. You can chalk it up however you want, which means you have full control to make this deal whatever you want it to be. And all we did is we turned around and said, look, you owe us $87,000, but we're actually going to forgive $22,000 in debt. Now, why would we do that? Well, there's reasons why, but the bottom line is now I'm owed a $65,000 debt, right? And the house is worth $85,000. So now they have some equity, some pride of home ownership back in their deal, right? Payment's about $544 a month, and we did it on a 20-year note. So to keep the math easy, that's about $130,000 coming back to me for my $21,000 investment, right? So we're netting six figures easily on that $21,000. Here's what's crazy, because it was modified. Within a couple of months, right, I can sell a partial, just the front part of that loan, for about $30,000. Well, we'll just say $30,000. So in other words, I can go ahead and take I could take all my money back, plus I make $9,000 today, right? Because I sold part of the note, but I also get all of the back of the note, which is another $95,000 coming my way. So I have no money in the deal. I got all my money back. I make $9,000 today, and I make another $95,000 in the future. How many times can I do that? Over and over and over, and it'll take me about 3 or 4 months to be able to do each one of those deals. So, I mean, it's silly when someone says, oh, I want to make 8% or 12%, 15%. Look, what you need to do is you need to learn how to do it, because there's more value that you can acquire by learning the skill set than you can by actually doing the deal, right? In other words, I tell people all the time, they say, well, how do you make your money doing that in the mortgage business? And I tell them, look, I make all my money between my ears. And what I mean by that is I learned how to do it. And because I learned how to do it, now the return on the investment piece is typically going to be infant. I'm never going to use any of my own money. And even if I do, I'm going to get it back substantially or very, very quickly. Because even then, what's your return on investment if you put up $24,000, you turn it if you put up $21,000, you turn it into $29,000 in 4 months, and then they're also going to give you another $95,000. What's your return on investment? It's a high number, right?
Yeah.
We say
yeah,
if you don't need a calculator to figure it out, that it's good enough.
So I used my calculator and I said, okay, if I did the $21K investment and I'm getting $544 a month, I'm sort of happy with that, because I do the math on the calculator and I get 31.1% return in the first year. But that return obviously is going to continue to compound and pay off the principal. So like, yeah, anyway, you cut the deck, like this would be one where you did the math on the napkin, you know, on the other side of that note the guy tried to write on his truck.
Yeah.
And it's like turning out to be a good deal.
Yeah. Yeah, exactly. And it's no different on the front. You know, if it's a performing loan, it's all the same thing. As far as the potential is absolutely ridiculous. You just got to take some time to learn it. And I teach a 1-day class for Eddie. Really all these strategies. I spend a whole day kind of going through them using case studies, and that allows me to kind of better show people, you know, case studies on a screen, you know, and that helps people understand a lot better, and they better understand. They see it in their own business now. They're like, oh my gosh, I know how I could do this now. I see this. You know, I want to stop wholesaling houses. I want to stop flipping houses. I want to stop owning rentals because I can have less headache and I can create substantially higher returns and build my wealth, as well as not have to give up all my money that I'm supposed to be making today, right? That was the biggest misunderstanding I had when I first heard Eddie speak in 2016 is I thought this was all about long-term retirement money. And he's like, no, man, it's your chalk and it's your chalkboard, right? In the long run, that's what I finally heard out. I heard that, or I figured out that I don't have to give up my money today in order to focus on building my wealth. I can actually have both. And it's using these strategies that's allowed me to do that. And that's really that was the easiest barrier to entry to accomplishing the vision that I'd set out for myself.
I love it. And I think that, you know, it's probably worth noting that there's really going to be kind of, in my eyes, I mean, obviously there's like multiple categories, but to me, there's kind of two categories of investing. For the sake of our conversation, we have truly passive, right? Fully passive. That's nothing. That's, you called in a wire, you waited, the wire came back with your interest or the payments came, right? That person's not planning on making a phone call. They're not going to engage a servicer, none of that stuff. And then you have what I would probably term the entrepreneurial investor, right? That's going to be most of the people listening to the show. I know for a fact we have like the passive investors who have no interest in going to do deals out there themselves. They just want to find guys like me, guys like you, and they're happy with 6, 8%, 10%, maybe a point or two. But then the entrepreneurial investor, this is usually the kind of person who finds themselves buying and selling houses, wholesaling, buying rental properties, doing cash out refis to take all their cash back because they're looking for like infinite return. Like what you described of, you know, I put 21,000 in, I sell a chunk of the note for 30. Really what's left is an infinite return because I have zero cash in that deal. So all the rest of it is profit, and I took some profit today. The entrepreneurial investor is going to have to be willing to trade off their time, and that time may be something that passive investor does not have additional time. They don't have time to come listen, you know, to the audios or sit in on the class and like really learn the details and then run marketing campaigns and negotiate. They don't have the time to do that. But they're probably doing something else with their time and getting a large return on that time too. So yes, there's much, much more substantial returns for the entrepreneurial investor, but the entrepreneurial investor like you and I has to also remember that we bring time and knowledge to the table in order to create these circumstances. Does that make sense?
Yeah, absolutely. Absolutely. I'm right there with you. And I always say passive, but the way you describe it is really great. I love that. I consider myself more the entrepreneurial passive investor. And part of it's because my personality type, right? I like to go have coffee with people. I like to go take people to lunch, but it's passive to me because I'm not running from appointment to appointment talking to seller to seller to seller anymore, right? That was enjoyable. I like doing it. I don't need to necessarily anymore because I've kind of transitioned to, man, there's more money out here than I could ever invest anyway. I just need to focus on the right type of investors and invest that money and not have to use any of mine and really start to grow my wealth. And in the class that I teach, I even, you know, because some people who are brand new, they even hear some of the stuff that I heard in 2016. And I say, look, even if you're brand new, right, and you need to make some money today, I can show you that. But there's no reason you can't start building your wealth. And I can show, and in fact, at the next 1-day class I do, I will teach the strategy of if you have $100, I can show you how to turn $100 into $100,000 absolutely tax-free. So even if you're like, I can't start investing in my future and my wealth and really get ahead because I need that money today. Okay, well, sell something on Facebook Marketplace over the weekend, come up with $100 and let me show you how you can turn that into $100,000. And then obviously you can do that over and over again. So there's just so many ways that you can do it. You just have to sit down, take the time to learn it, get introduced to it, and then figure out, all right, which one of these lines up with my preferences. And that's kind of my passion, is helping investors see, like, look, there's so many ways to do it. Let's look at a couple that I know will work and just pick one and go for it. Like, just get engaged, get involved, and go out and make it happen. If that means you're going to be talking to sellers or running appointments, great. If it means talking to private investors, great. If it means just buying a note from Eddie Speed, even, like, there's just so many different ways to get involved. And I think as people kind of hear about them, they start to easily get to that place of like, oh, I get it. Okay, I know how I can get plugged in here and do this or take this next step on my journey in my business.
Yeah, and I think the part of, the passive versus the entrepreneurial is I've had to wear both of those hats, and where I'm investing my time and my team, we have a really good, solid thing going, and it's making money. But now it's like, oh, do I have the time additionally to go into the note business at this, entrepreneurial level? Dan Breslin doesn't, because I'm running the main company. And so, like, that observation comes from my own investing of, well, geez, I kind of need this, like, more passive, literally, like, as passive as I could possibly get, no ad. Like, I'm complaining about the reading of my rental statements. And I'm sure some people who, like, can't wait for the statement to come and see how much they made. I'm like, oh man, I haven't checked it in 3 months. This is so irresponsible. And I find, like, problems on there, I'm, like, embarrassed to almost admit. Go ahead.
I was going to say, so I've not really told anybody this strategy, but you brought up a point that I think is really fascinating, because I actually have an investor. He's a friend. He's totally a friend of mine. He's a buddy in my life that it's the same thing. He's like, Brian, you think I have time to go and pick out a note? You think I got time to go and call the note servicer? I'm like, okay, I get it. You're slammed. You make a lot of money. You're focusing on that. What if I could show you a different way? What if I could make this truly passive, like literally call me once a year and the business runs on its side? Like, what if I could do that? And basically the strategy I put together for him is this. I said, hey, I've got things pretty automated over here. Like, I've got my business, and I'm not saying this is going to be for everybody, but this will hopefully help your listeners kind of see how flexible you can make this thing. Because I saw this one opportunity. He had about 140 and change. Can't remember exactly. And he's like, I want to put it in notes, but I don't want to go do all these things to get the 10%, 12%. And I said, all right, check this out. Would you be interested in this? What if you put that money in an account, right? And I'll go buy notes with it, right? And then you just need to, I know several of his friends, you just need to simply say, hey, listen, I'm doing this note thing with Brian Lauchner. You should get in touch with him. He wants to talk to you about an investing opportunity, right? And he just introduces me to his friends, and I sell partials out of that account that I have with Dave, my buddy, right? And I sell partials to his friends who are looking for I'm looking for 5, 6, 7, 8% investments, long-term, low risk, and that kind of stuff. And what that does for Dave is that gives him really no work other than some introductions here at the front end. It also allows him to make insane returns, because I'm going to sell partials, get all of Dave's money back, but Dave's going to give up half of everything. But Dave doesn't mind giving up half of his money when his money is just going to stay there. It's just going to be turned over and over and over and over again. And so it's just a little bit unique of a way to do it, because we're selling, let's say I sell 10 years of a 30-year note. Right? I'm going to recoup all the capital I invested, but that means we get 20 years of payments on the back end. So I'm building up this huge nest egg for Dave and for me, right? For future money. This is truly more of a future money play, but that allows Dave to truly be literally passive. Like, I haven't talked to him in almost 2 months now, actually, now I think about it. I mean, he just put the money in an account and let me run with it. And I mean, I'm at a spot in my business to where I'm already vetting the deals. I know what I'm looking for. I can buy notes with it. And then I just sell the partial. So it becomes very little work for me, but I literally got half of that $140-something thousand plus all of the wealth in the long run, and he's going to make better returns doing it that way than he's going to make with literally any other investment he could possibly put it into right now.
Nice. Sounds interesting. I'm going to switch gears here a little bit for our topic here. And before I do that, I want a yes or no answer. No elaboration, because it'll be explained at the end. But I want to know if, during that 1 day free event that you put on for listeners of the show, do you go into detail about that $100 into $100,000 play that you mentioned?
Yes, I do.
Great. So keep listening until the end. And the new topic we're going to touch on, which we briefly did already, was creative financing. So you and I went back and forth here for the last, little while on the note business itself and the passive aspects. But let's back it up to when you were belly to belly in the living room doing deals with sellers, because I think a lot of our audience is still doing exactly that. And I think that these creative financing strategies hold value for what people are actually doing today, as perhaps they make a similar transition that you did over the last couple of years.
Yeah. Right now in 2021, right, we're kicking the year off here. The biggest need in the real estate market that I'm seeing is the need for people to master creative financing. That really is the biggest need in the market, because pretty much every market right now is going up and up and up, and investors are talking to sellers and they'll say, "Hey, I'll give you this price," and the seller says, "Well, I want $1 million for it," and you're like, "What are you? Where did you even come up with that number?" And they're like, "Well, John's house down the street sold for that much," and you're like, It's not even the same type of house, man. Like the seller sentiment has shifted so much. What sellers believe their house is worth has shifted so much. How are you supposed to compete in a marketplace where the seller wants everything and you've got to buy it at a deep discount in order to make money, right? Because wholesalers only make money on margin. So I think that's why it's one of the biggest needs in the marketplace right now.
Yeah, I agree. And some of the other thing, and we briefly touched on it, I don't know if we actually tagged it Be the Bank, but we're going to tag it for this chunk and section that we're going for now as being the bank. And I learned over the years, and I'm sure most of the audience does know or may know sort of what happens, right? The mortgage lender, I'll give you a story. So I refinanced my house in January of this year, and I went to PNC because I have a bank account there. I figured, well, PNC's big. They should be able to give me a reasonable rate. I'm already doing a lot of business with them. I thought they would have just been able to go into my account and see that I had money there and was making a mortgage payment. Anyway, I did all the paperwork, got the loan with PNC, and then we closed on the loan with PNC. And then a month, 2 months later, something like that, I get this thing in the mail that the mortgage was sold to another investor. So what PNC did was just like kind of what you were talking about, Brian, of, you fund the deal and then a month later it's sold and, the cash comes back for PNC to lend out again. But in your case, or in someone's case who's going to do deals face to face with sellers, we're recycling that cash by selling out the note to the other end. So you touched briefly on getting a seller to hold paper and do deals on terms, sell the house on the deal with terms. And I think that the piece that's really cool that what you're doing is, we kind of also bolt that to the Be the Bank strategy and getting into and paying attention to the note market to be able to cash back out. I feel like that might be the piece that's missing from some of the get a seller to do a terms deals. At least it was for me for a long time. I never could imagine that someone was going to buy the note. I structured my notes incorrectly, so when I turned around to sell them, I was the guy with the piece of crap note that was written on a napkin pretty much. It wasn't serviceable. It was like a big problem, and I'm still in a legal battle, which I'm going to win and get my money back. But I screwed my business up and wasn't able to resell the note to get cash back out of the deal. So I feel like having access to, being aware of, being plugged into a network of people who are buying and selling notes and treat them as something that's valuable is a critical component to the creative financing strategy. Would you mind elaborating on that a bit?
Yeah, I think it's twofold. So being able to sell your notes is is crucial. And in fact, I'll make sure, during that one-day class that I even go through, who some of the bigger buyers are that you could buy, that you could sell your notes to. But I think one of the things that's often overlooked is people are so interested in exiting the deal that they miss an opportunity. And that opportunity is to simply hold the note, but have somebody else pay for everything. And what I mean by that is my sellers, oftentimes the seller is willing to pretty much, they'll leave their equity in that deal, right? They'll say, hey, look, you owe me $200,000 and we're going to amortize it over a 30-year note, but in say 15 years, I want to be paid off. They want some kind of balloon on it or something. Maybe that's the case. Well, that means they're going to let you borrow this money basically for 15 years. They're going to play the role of the bank for 15 years. Well, I'm going to turn around and I'm going to resell. I'm going to package it up and I'm going to resell that, right? And I do a good job of explaining this and going through the details on that one-day class, but I resell it to a very unique buyer, somebody that we call a penalty box buyer. That's an Eddie Speed term. And what that means is, again, this is somebody who they can't get conventional financing anyway. Instead of what they're going to do is, it could be anything. It could literally be a self-employed person, right? I was a penalty box buyer for 2.5 years because when I first started, I had lost my job. I didn't have a W-2 anymore. I had to have 2 years of income from my self-employment to be able to show before someone would write me a mortgage, right? That was my situation. And so it's not that I didn't have the money to put down. It's not that I didn't have good credit. I was a very lendable character except for the piece that I didn't have 2 years of tax returns for the bank that they liked. Another common example is entrepreneurs who use the laws to write things off and pay less taxes, right? They have money, but they're just, they're not going to pay taxes, right? Because the laws are written in your favor. So that's just one example, right? There's a bunch of other ones. One of the most common ones in my area is I-10 buyers. People who don't have a social security number, they have an I-10 number. They're the people who legally are here, they legally work here, live here. There's pieces that are missing for a lot of banks. And I turn around and I resell to these people because, first of all, they typically have good down payments. And we've got some good marketing ideas for how we draw those people in so that we're always able to pick, out of the 2 or 3 probably best ones and leave us the best options. But it allows me to get a solid down payment and the fact that they're going to continue to pay. And what that does is that payment will pay my underlying mortgage. It's no different than having a mortgage and renting it out, right? The rent payment covers your mortgage payment. Well, in this case, my mortgage payment is a mortgage payment to the seller. The seller has decided to play the role of the bank. I got rid of the bank completely. My seller is going to sell me the house and they're going to assume the role of the bank. And that is my underlying mortgage. The difference is with that seller, I can get terms that a bank would never get me. I could get no payments for 6 months. I could get 0% interest or really low interest, right? I could also get no money down or really low money down. It's just about, Eddie calls it the talk off. It's about mastering how to say it the right way and using a logical and rational conversation rather than some slick salesy type of an approach to convince the seller that they should play the role of the bank. You're going to show them why it's in their best interest. And then once you have that locked up, you're going to go resell it to a penalty box buyer who's typically going to pay between 6 and 10% on average. I'd probably say about 90% of the time that's where you're going to be, right? Yes, there are cases for over that and under that, but in general, between 6 and 10% interest. And you're just going to mirror the terms. And obviously, by having a much higher interest rate, that's going to generate a much higher payment, which is going to create your cash flow. And that's really how I'm able to make money today by talking to sellers and then also get the cash flow, keep the note, not even sell the note. You could always sell the note if you wanted to. But what you're going to find is once you have no money in it, why would you want to go off and sell that cash flow when you know it's going to be coming in? Right, unless, again, you just need that money. But if you really need that money, it's probably easier or better to just go do another deal and get some more bonus cash flow.
Yeah, that makes sense. How important is your ability to understand the nuance of the specific seller situation? And do you have any examples of times where you noticed the seller needed this or that thing that was important to them, and then you ask the right question and use a certain type of term to fit that? Does that make sense?
It does. I mean, a lot of times people think that they're looking for, and I've had somebody ask me this before, like, okay, like walk me through, like write me out the sentence you say. What's the magic word that you say? And it's like, it's not like that, right? That's the slick salesy stuff I'm actually talking about getting away from. What I'm talking about is you got to approach the deal to where you can get the seller comfortable to be willing to be transparent with you. Because I think we can all agree, if you don't address the seller's real problem, you're never actually going to get that deal done anyway. So you have to find a way to get to the seller's actual pain, what their real problem is, get them to be transparent with you. And by doing that, by getting them to say, okay, this is what I really need. Okay, now you've told the doctor what your symptoms are. Let me tell you what some options are for the prescription, so to speak, right? So a good example is in that one-day class, I talk about a student, a note school student who he went out and the seller was adamant, I have to have $450,000. I have to have $450,000. And as he sat down with them, he started to understand, man, this guy really needs this money. What do you need this money for, right? Sometimes it's really just asking that question. What do you really need this money for? Well, I got this and I got this and I got medical bills and we're moving again and I want to pay for my granddaughter's college tuition this semester and all this. Okay, well, all of that's good. But is that $450,000 worth of stuff? No, it's not. Okay, well, let's do a little exercise here because I think I have a couple of options for you if we can get the numbers right. What all do you need? Okay, you need this money and this money and this money. Well, really what you need is $50,000. Would you say that's right? If I could give you $50,000 today, that would solve your immediate cash needs. Yeah. Okay, so then you don't need $450,000. You need $50,000 now, right? Okay, well, what if I give you $50,000 today? Would you be willing to carry that other balance, the other $400,000 in that example? Would you be willing to carry that $400,000 balance over time and let me give it to you in monthly payments? And the seller was like, yeah. The seller in this case was in their 70s, and so they did not want to wait more than 10 years. Kind of funny. He was like, I don't want to die before this thing's over, right? So he said, all right, that's fine. We'll amortize it on a 30-year loan so I can get a payment lower, right? Would you be okay with about $1,100 a month? Now, pay attention to how I said that. Would you be okay with about $1,100 a month? Yeah, I would be. Okay, great. Now, what wasn't discussed so far? The interest rate. And so what this guy did is he addressed the immediate cash needs. You need $50,000. I'm going to give you $50,000 today. Now, in this case, he had $50,000, but I also talk about how you don't even need your own $50,000 to do this. And that blows people's mind. Like, wait a minute, how are you going to give him $50,000 if you don't give him $50,000? Right? And so there's that. But then $1,100 a month on a 30-year amortization is actually 0% interest. So he got 0% interest, $11,000, and then it had a 10-year balloon. He had 10 years to either refinance the house or pay off the house or sell the house. But he didn't even do that because when he packaged all that up and he resold it to a penalty box buyer, he just made the penalty box buyer agree to the same terms. Hey, you got to put, in this case, $75,000 down because he wanted to make $25,000 today. And you've got to pay, I think it was like 6 or 7%. I'll have to go look at the numbers again, on a 30-year amortization. And you have 10 years to either refinance the house, pay it off, or sell the house. And so he just made the end buyer agree to the same thing. And it allowed him to make $25,000 today and keep all that cash flow. And at a $400,000 note, when you're at 0% interest and you reloan it out at whatever the 6 or 7% is, it's huge cash flow. I think on that deal, he had like $1,500 a month coming in. Out of cash flow, plus the $25,000.
The retail value of that house in real time when he signed at $450. Are we talking it was worth about $450? Was it worth a little more, a little less?
It was worth a little more. So he resold it for $475,000 to a penalty box buyer.
And so we do the math, and if he held it 10 years, he'd be looking at $132,000 in pay down. That his mortgage terms buyer would have actually been making that, plus he made the interest spread every month on that payment. And then he's got all of that pay down's like money in the bank if he kept it 10 years, but he's also got that extra $25,000 on top of the sale price. So like if it went to a 10-year term, he's looking at a really, really good deal. Really good deal.
You want the punchline? I just pulled it up. Punchline is $287,000 is what he made on that deal. If it goes to term, if it goes to all 10 years.
That's phenomenal. So he's looking at
no money
130 grand in interest. Yeah.
Yeah. All on a deal that you got to remember, this is retail. So it's not like he could have wholesaled this anyway. And even if he could wholesale it, was he going to make more than 10 grand on it? Probably not. Let's be nice and say he was going to make 20 grand somehow on it. No, instead he resold it and made $25,000 more than he was going to make as a wholesale fee. All in a deal that, I mean, other investors were walking away from because this guy, quote unquote, has to have $450,000 for the house.
Yeah, that's just, yeah. The particulars of that deal, does a deed get transferred and recorded, or was this like a different type of documentation rather than like a mortgage and a deed with the original, with every seller and buyer? I mean, how does the paperwork look on that deal?
Yeah, the good news is this: I had actually accomplished, I think, 3 deals before I even understood this, because I've never tried to figure this out myself. The attorney here in Dallas who closes my deals, he handles all this stuff, and he just is like, this is going to happen, this is going to happen, but it just never really sat in. But in this case, yeah, the seller sold the house, so he transferred ownership, right? He deeded it over, and now he has a mortgage note. He holds the note. He's the bank now, right? And that's how he's protected. So yeah, there's a deed that transfers name. Yeah, and on this tends to confuse people right out of the gate, and this is why I teach a whole 1-day class on it, is because when you actually take the time to break down the details, it becomes a little bit clearer. But the same thing with the penalty box buyers. He's going to have what's called a wraparound mortgage, right? So the steps are there. It's just the logistics aren't super complicated. And I've tried to do my best to illustrate this so people understand. My biggest desire right out of the gate is for people to understand that you can buy houses at retail and make more money doing it that way than you could if you were going to wholesale it, right? Even if you bought it for 20 or 30 or 40% off. It's a strategy that in today's marketplace is crucial because so many people want such a high price for their house. And so you can be the first person to walk in and be like, okay, I'll give it to you. But here's how that needs to look. Because it's not about the price you pay, it's about when you pay the price.
Yeah, and the only risk to your student in this one is if the borrower goes bad and he has to file a foreclosure and gets the property back in significantly worse condition. In theory, he could just turn around and hand it to the seller. But like, I know if that was a deal I was doing and the seller entrusted me with the property, like, I'm going to see the deal through and I will take the loss on a deal like that and foreclose for a year, however long it takes, and also go back in and paint the property and resell the property. Like, that's just kind of who I am, that I see the deals all the way through. Yeah. But there is that risk of the thing blowing up. But with the potential upside of $287,000, if you go in with your eyes open, I think you're well aware of, the risk versus the reward, and the reward should outweigh the risk. And I also would probably underline that $450K deal. These are probably a little more retail than most of our wholesale only, the house is full of mold and no one can live in there. Like that type of deal is probably not going to fit. I think this probably fits a little bit better for houses in slightly better condition that, quite frankly, seller doesn't deserve to take a discount. The property's in great condition, right? Right, Brian?
Yeah. Yeah, that's right. I mean, the strategy works whether the house needs rehab, whether it's a junker, whether it's really, really nice, whether it's HGTV worthy. I mean, there's so many, there's not an example that it doesn't apply to. It's just a matter of how do you make the numbers work, right? And to your point earlier about the risk, right? You've always got to consider that. Well, like I told you earlier, you've got to look at the borrower. And one of the easiest ways to mitigate that risk, the guy put $75,000 down. Is he motivated to make that payment every single month? I think so, right? That's part of your aligning the incentives to make sure things work out. Now, obviously, yeah, the guy could get hit by a bus. The guy could, lose his job. He could get really sick. Sure. And so you're right. But you don't get to control any of that. So you just have to set the deal up the best you can and align the incentives to make sure he's going to pay or she's going to pay.
Nice. So as we get to our wrap up here, before we get into our last final questions, is there anything else that I just didn't have the foresight to ask that you think listeners would be interested in, Brian?
Oh man, I don't think so. I mean, probably the only thing I could think of would be some details of some stuff, but we just don't have time to cover it today, and we've got a solution for that. Right? So
yep. So let's go with some book recommendations. Do you have one or two books that you find yourself recommending most often to people who maybe come through the note school or friends of yours that want to get into the real estate business maybe?
Yeah, but what's really funny is neither one of them are real estate books. But they're two of the two books that I'm thinking of off the top of my head were very impactful for me, because when you own a business, when you work for yourself, your mindset is like, it's just crucial. I always say, like, as an entrepreneur, you don't get to have a bad day. Right? You just always have to have good days, like mentally, because once you start getting down on yourself, it could just go south, right? And so one of the books I always tell people about is called The Third Door. The guy's name is Alex Banayan, I think is how you say his name. And I haven't read it in a couple of years, but it's a fascinating book about there's always a way to make something happen. In other words, a building has a front door and a back door. You can go through the front door, and if you can't get in the front door of that deal, you got to go into the back door of that deal. But sometimes you get stopped at the back door. And so what do? You find the third door, meaning that there is a way to accomplish pretty much anything. And it's this Alex guy he's telling his story, and he accomplishes the craziest stuff because of this mindset shift of, like, he doesn't just take the loss. He doesn't just say, there's not a way. He just says, there's got to be a way, right? There is a way. And it's just bananas. So that's one of them. And then another one that I think that, and I don't know how many of your listeners know about Chris Voss, but he wrote a book called Never Split the Difference. It's all about negotiation. He was like an FBI hostage negotiator. And his whole point is, it's funny, we learn how to talk to sellers, we learn how to negotiate deals, and I'm not saying that it doesn't work, but his approach to how to do it is just so eye-opening. He explains a lot more about why people act the way they do, right? It's more the psychology of why your seller's telling you no. And it's probably something that you did. And so his whole point is that most of the time you go in to negotiate something, your seller's at $100,000, you're at $90,000, you try to convince them that you need to just buy it at $95,000, because that way you're like, oh, I still make some money. And his whole point is, if they're willing to get close to you, you should never have to split the difference. And here's why. And here's how you're going to make sure that you don't have to split the difference moving forward. And so it was one of those books that it's like, man, this could really increase my average profit per deal or whatever it is for years and years and years. And so I just found it really powerful. And he's just a really fascinating guy to listen to. I mean, think about a hostage negotiator for the FBI. Like, he's got some insane stories, as you would imagine.
Yeah, man. Nice. I'm excited to check out Third Door. I did read Never Split the Difference, and same thing. Could just say the same exact things. I mean, he's bringing a really unique perspective in that he was negotiating for human life. How are you going to split the difference on a human life with a terrorist?
Yeah, exactly.
Right? And then now we can apply those to our real estate deals, where we thought the stakes were really high in our real estate deals. Certainly I did. Oh, yeah, this is, highfalutin stuff. We're negotiating real estate deals. And it is, right? These are people's lives that we have in our hands, and they are serious to a certain extent. But it isn't quite the gun-to-the-head hostage techniques that Chris Voss developed. So, yeah, would have put a big underline under that one for sure. Cool. Ryan, the crown jewel of wisdom. I'm going to change up from our normal format here. So the long-term listeners will probably notice the tweak here. But let's set the stage. 2021, your bank account gets wiped to zero. You have no deals on the board waiting to close. There's no follow-up. There's no leads from note buyers or wholesale sellers in your queue, right? You're kind of starting from nothing, except you know everything that you know now in 2021. How would you get started again?
I would become what's called a designated hitter. This is going to take a little explanation, but I'll try to keep it quick. A designated hitter is somebody who you have no money, you have no credit, you have no marketing, you have no money for marketing. But what you do is you know how to do creative financing. And so what I would do is I would go out to pretty much the people who are doing 30, 50, 100 deals a year. And I would literally say, hey, I have a very unique skill set to where I can close deals that you can't. Now, I'm not saying that you can't close deals, but what I'm saying is this. I have a criteria of the exact type of house that I want. If you get a lead and you can't close it, even after your follow-up, you can't close it, I want you to send it to me, and if I close it, I want to split this deal with you. Whether it's I split the down payment with you, whether I split the cash flow or both or whatever, I'm going to go in and I'm going to give this seller exactly what they want, and I'm going to structure it on terms, and I'm going to do it that way. And that's what the designated hitter is if you have absolutely nothing, but you can understand the concept of structuring a deal on terms, then man, it's awesome. And then at that same time, I would be helping other businesses in my community, right? I'd be able to make a solid income, but I'd be using my leveraging my knowledge to do it without having to do any marketing. And that would allow me to get some deals done like ASAP because the leads are already there. They already have leads in their trash can that they didn't close, right? So I could just say, send me any lead like this. And if I don't close it in 30 days, I give it back to you. I'm done with it.
Nice. I love it. I like it. It is something I kind of suggested myself in the past, but what you're doing is you're identifying a player in your marketplace who has substantial volume. They probably paid a lot for those leads, whether it was a lot of time building the database, compiling it, and then you're bringing you're bringing the time to the table and your willingness to, work on the leads, and add value. So I think that's a really, really great answer to that piece. I love it. Brian, so we touched on the Note School, full day that you put together. Would you mind elaborating on that and telling listeners where they can get started if they would like to check that out?
Yeah, totally. And I'm super excited about this because for your group specifically, it's free, right? Normally I'm trying to charge people like $97 or so to come out and teach for a day because I want to get paid, right, to do it. But in this case, it's been a lot of fun. If you guys go, if you're thinking, look, creative financing could really help my business, right? I could see how sellers want more than I could give them. I need to find a way to just give them what they want. Or maybe you're trying to figure out this note business, whether you're creating your own notes, you want to wholesale notes, you want to flip notes, you want to do performing notes, you want to do non-performing notes, any of the things that we talked about today. This one-day class that I teach, it's from about 9 to 4, depending on how many questions I have. You can register for free if you'll go to REINoteschool.com. REINoteschool.com, and you can register for the class for free. If you go through a Note School site, if you go to a different website, you'll have to pay. So if you're wanting to go for free because of this podcast, you've got to go to REINoteschool.com. You'll be able to attend. It's obviously a live class, so bring your questions. I try to make it as engaging as possible. We take breaks. We take a lunch break. You know what I mean? But it's a day packed full of content, and it allows me to take these case studies that I've seen, or even stories of deals that I've done, and show you the steps of how I got to making this money on it, or whatever it is, right? And it helps you to better understand that when you see a deal that you think is impossible, there's a third door. See, that was a good tie-in, Brian. So. So REINoteschool.com.
Yeah, we did no justice whatsoever on our audio today. You did a great job, with the details, but we did no justice to the detail that's kind of required to keep up, how these things work out with these different percentage spreads and the rate of return and how to sell this chunk of the note. So go check that out for sure. Brian, I had a blast. I got pages and pages of notes here, a ton of great information. I really appreciate you taking the time today to share with our listeners. Thank you for coming on the show.
Yeah, I appreciate it. It was a lot of fun. Thanks for having me.
So are you interested in doing deals with no money down? Creative financing? Sounds like a good idea, right? Then you might consider diving deeper into the mortgage note business. The mortgage note business is the creative financing strategy in real estate. First, negotiate no money down deals with sellers. Then find a buyer willing and able to put some money down and continue making payments until the deal is paid off with a profit for you in between. And one of the things with creative financing is that you can sell properties for much higher prices using creative financing. So here's an example. I bought a package deal a few years ago, and as part of the package, I think there were 5 houses that I really wanted because they were in the right area, and there was a 6th house for $20,000 not in the right area. That house that I had to buy for $20,000 as part of the package, it was worth about $20,000. And I tried selling the house on the market for $20,000, plus or minus, leaving the room for the commission, but to no avail. The house did not sell. So I removed the listing and I wrote a Craigslist ad offering that same house for $45,000. And this time I added creative financing. So the deal sold for a price of $45,000 with $8,500 down and $443 per month for 10 years. So the deal was off my plate, collecting payments. Now, if the deal runs all the way through the 10 years, I'll end up with a total of $61,660 on a deal I couldn't sell that I had to buy for $20,000, which amounts to a profit of $41,660. Not a bad deal on a deal that I couldn't even sell to break even, right? So what's the best way to learn about creative financing, no money down deals, and the mortgage note business? Well, you're in luck. My friend Brian Lauchner is hosting a full-day virtual workshop in a few weeks on exactly that topic. And normally this costs $97 to attend, but as an R.E.I. Diamond Show listener, you can attend free when you register at REINoteschool.com. This class is a full day of content, tons of examples of real deals, and of course many of these deals are the crowd favorites. No money down and extracting a nice chunk of cash up front, followed by years of additional payments. So go check the schedule and sign up at REINoteschool.com. Thank you for tuning in to the R.E.I. Diamond Show. Remember to review and subscribe on your podcasting app. Just search R.E.I. Diamonds and click subscribe. Are you interested in receiving my weekly Big Idea email where I provide the most valuable jewel of wisdom I discovered during the recording of the most recent episode? You can sign up at reidiamonds.com. And at that site, you can also access the 180 episode archive. Again, that's reidiamonds.com. So in 2020, my house flipping business, Diamond Equity Investments, bought and sold 283 houses. Mostly houses. A few were apartment buildings. And we've done 12 so far this year in 2021. And we currently have another 116 houses in our inventory, either under construction or under contract and waiting to close. So here's how we can do business. Number 1, are you interested in having access to the best real estate deals in your market? In other words, access to deals that you can buy at low enough prices to actually profit after renovating and reselling? If so, go now to accessrealestatedeals.com. Number 2, are you an accredited investor who enjoys double-digit returns? If you'd like to potentially invest passively in my real estate deals, go to fundrehabdeals.com and sign up to receive my private mortgage investment opportunity emails. And number 3, of course, I am always buying houses that I can flip, and I also buy occupied apartment buildings with below market rents. So if you have a deal that fits that description in either Atlanta, Chicago, or the Philadelphia region, please send me an email with the details. We are at the conclusion, my friend. Next up, we have real estate agent, real estate investor, and builder Joe Bell joining us with a discussion on running a billion-dollar brokerage business and developing million-dollar homes in the Anchorage, Alaska real estate market. Until then, signing off.
Thank you for listening to this episode of the R.E.I. Diamonds Show with Dan Breslin. To receive email notifications of new weekly episodes, sign up at www.reidiamonds.com.